afternoon and welcome to Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. We have a good new guest today, and she's Jessica Amir, market strategist at Saxo Capital Markets. Jessica, great to have you on the show.
Great to see you. Happy Friday.
Now, Jessica, before we get your insights, let's first take a look at crypto markets and how regional stock markets are performing. The Singapore Stock Exchange is at 3,177.64. It's up 0.8%. Now, looking across the regional stock markets, we've got the KLCI, which is up 0.6%, Shanghai, which is down 0.36%, the ASX All Ordinaries, which is up 0.05%, the Nikkei, which is up 0.48%, the Hang Seng, which is down it's up 0.01%, and rounding up the numbers, we've got the Kospi, which is down 0.41%. Now over to crypto markets, Bitcoin is at 22,902.9, it's up 0.09%, and rounding up the other crypto, Ethereum, which is at 1,563.16, it's up 5.24%. Now, Jessica, markets have been on a tear. Please tell us why.
Yeah, a great question. So markets have been on a tear, I guess, for a couple of reasons. Firstly, we are seeing treasury yields or bond yields fall off their highs. And secondly, we are seeing the US dollar fall. So if you have a look at the US dollar index, the DXY, which is a basket of currencies up against the US dollar, that's down 2%. And I should say there's a third very important reason. Geopolitical tension has eased somewhat. And we saw gas flow back into Europe from Russia. And also we saw the oil price has got a lot of reprieve. So the oil price is actually in a bear market, down 20%. So this is kind of abating some short-term inflationary fears. And then finally, on the equity standpoint, we've got less bad earnings reports so far. So all in all, combine everything together, and the markets have been supported up off their June lows.
Now, looking ahead, what are some critical reasons that perhaps equity markets could move south, and what should we be watching out for?
Well, there's a lot to look out for. So I will say there's a lot of caution in the air, but we do have four key measures that we are looking at the moment. But just thinking immediately, if we have a look at what data is on offer imminently, we've got Snap, who was, I guess, a kind of a gauge on how the businesses are feeling about spending for 2022. And Snap's downgraded their outlook for the year because businesses are less reluctant to spend because they're still facing rising inflationary concerns. And of course, wage growth is rising as well. But of course, we've got, I guess, the world awaiting Apple and Microsoft's results next week. And we also have got two important economic reads out next week. We've got GDP out for the US and also the Euro area, as well as the Fed's decision. So the key risk here is that obviously the US goes into recession, and secondly, that rates rise more than the market expects. So that'll take a lot of heat out of those key inflationary linked sectors, so consumer spending, tech, and also property. But if we just touch on the four key elements that we're watching and why we think markets are slowing down at the moment, I'm not sure if we've run out of time, but I guess the first thing is we were speaking about before we went live on air is that, Brian, property demand is starting to show signs of crumbling.
So and that's in Australia, right? Because you've had historically low mortgage rates, I think as low as 0.05%, and they've risen sharply. And the Australian consumer is stressed in terms of borrowings.
Yeah, absolutely. Absolutely. I mean, it's not just in Australia as well. We've got to think about the more broader consumer cohort, and the US is under severe financial strain. So property buying, property lending, I should say, has actually fallen for the fifth straight month. And we're also increasingly expecting more banks to announce bad debt provisions. And we also have to remember, as you said, the consumer's pretty dovish. Consumer sentiment is at lows in the US, in the UK, and it's crumbling away in Australia as well. So we're starting to see what's called the reverse wealth effect. And we think that this will probably grip markets later on in the year as property prices fall. So that's the first thing that we're watching. And then the second thing that we're watching is that financial conditions are only going to get tighter. So underlying inflation, we see that persisting. So we see food prices picking up again, and oil demand also picking up later on in the year. So what's happened at the moment, we spoke about the oil price coming down 20%, but that's because paper traders are actually contributing to that pullback. But basically what we're saying is that equity gains at the moment will probably flip into reverse territory, and we could see those interest rate sensitive sectors turn to losses as the Fed and the RBA rise rates more than expected. And then we do have a third element, of course, and that is what we were saying earlier, the bond yields. So the 10-year bond yield, it's just shy of 3%. So if you think about that, like investing in a boring bond, I guess, got to be careful saying the word boring, but investing in a boring bond can get you a better yield than investing in the broad US market. So you get a 3% yield versus investing in the S&P 500 or the NASDAQ or the Dow Jones, and you're getting a far less of a yield. And then growth is quite restricted because liquidity is getting pulled out of the market. Then you think about what's going on in Australia as well, Brian. Our 10-year yield this week has hit 3.5%. That's the Aussie government bond yield. So 3.5%, that's actually a better yield than a lot of blue chip ASX stocks. And remember, Australia, we're home to the biggest dividend paying companies in the world. So this is a bit of a concern. And we do see investors really holding off until rates pivot and then start to be cut next year. And then, of course, the big elephant in the room is that most companies are downgrading earnings. So earnings estimates were far too low, and the talk of the town is actually delusional. So we're hearing a lot of people, Brian, say, oh, earnings have beat expectations. Well, okay, but earnings are actually down. So US S&P 500 earnings season, we've only seen 20% of the companies report earnings. But diving to the detail, those companies, the average earnings growth is in negative, Brian. So the market hasn't factored this in. That's the prior quarter. But what about going forward? That's actually quite bearish. Every single company has guided for a murky 2022. In Australia, they're guiding for a murky 2023, except some energy companies. So we see that this is a huge area of concern. These 4 reasons why markets will probably pivot and head south again.
So Jessica, then where are your clients putting their money to work?
Well, there's a lot of areas. Our clients are pretty defensive, I will say. However, that's for the investor cohort. The traders, Brian, across Asia Pacific, most clients over the past couple of weeks, and indeed this week, have been net buying. So they're taking a tactical view on markets, so expecting this rally to continue to gain a little bit of momentum because results are less bad. And they think that the Fed might not hike as much as feared. So that is contributing to this momentum and this upward pressure in markets. So all in all, most traders are buying. Also, if we think about more broadly, what are they buying? They're also buying into bonds, given those attractive bond yields that we spoke about. You can get a better yield in a safe as houses government bond than a lot of equities at the moment, excluding, of course, energy and oil companies. But then if you have a look and scratch beneath the surface and look at the stocks that people are buying, Tesla, that's the most traded and bought stock this
That's
week,
interesting.
Saxo. Yeah. However, what has got more buys is Ford. And separately and lastly, a standout was buying in Apple has picked up ahead of their results next week.
And Apple is an interesting stock now to watch because they may be positioning themselves for a next wave of growth, because with their new financing or subscription scheme, essentially they're going to eat the lunches of buy now, pay later companies, as well as other companies providing finance for their products and services.
Yeah, absolutely. That's a key area of growth for Apple. And we see that this being a huge driver for the rest of 2022. So thinking about companies that can go above and beyond and grow their earnings via innovation. But you've also got to think about where it lays across, your region, across Australia. It means that Apple is going to take market share from, the likes of, Walmart, where you can buy your Apple devices, but also telcos like Telstra and those companies who actually you get your mobiles through. So now that they're going to make the mobile phone more affordable, it's going to really become a very much larger company and also dwindle market share out of telcos and also many stores that you would typically buy your devices from.
Now, Jessica, it's been a fascinating conversation. Thank you very much for coming on the show.
Thank you so much for having me.
Now, we've been speaking to Jessica Amir, market strategist at Saxo Capital Markets, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. Please like and subscribe to our various platforms. Thanks again for tuning in.